Welcome back to Boring Currency, where we follow physical metals, paper market stress, and the forces reshaping the global financial system. Imagine this for a moment. You open the markets and everything looks calm, almost unnervingly calm. But beneath that silence, buried deep inside the balance sheets of major banks in London and New York, a regulatory shockwave has just detonated. This is not a test. This is not speculation. This is the precise moment the Bank for International Settlements activates the Net Stable Funding Ratio, or NSFR, a rule nearly the entire financial system has ignored until now. For 15 years, bullion banks lived in a manufactured reality where paper promises were treated as equal to real metal. They leveraged positions 32-1 without holding meaningful reserves. As of today, that illusion has ended. The new regulation requires banks to maintain 85% stable funding for every ounce of unallocated gold or silver on their books. Think about the implications. A bank holding $1 billion in paper shorts must now back that exposure with $850 million in hard cash or Tier 1 capital. They do not have the cash. They certainly do not have the metal. What we are witnessing is a mathematical contradiction colliding with a regulatory deadline. Ignore the flashing tickers for a moment. Focus on the data I'm about to share, because the architecture of the global banking system has just rotated 180 degrees, and there is no reverse gear. Before we go deeper, I want to know who is witnessing this moment with us. Drop a comment below and tell me where you are watching the markets from today. New York? London? Somewhere else? Let me know. To grasp the scale of this event, we must strip away the daily news noise and look directly at the plumbing of the financial system itself. What follows is a forensic examination of how the bullion banking model functioned before today, compared with the cold mechanical reality of the new regulatory regime. This has nothing to do with sentiment. This is structural engineering, and the structure has just been condemned. Let's start with the asset definition. For decades, under Basel II and even through the transition into Basel III, unallocated gold and silver were classified as low-risk assets. When you buy unallocated metal or when a bank sells a futures contract on the COMEX, no specific bar is set aside with your name on it. What you receive is a claim, a promise, a liability on the bank's balance sheet. These claims were treated as liquid as cash, enabling fractional reserve practices where enormous volumes of paper were issued against minimal physical inventory. The net stable funding ratio changes that classification entirely. As of today, the BIS has redefined unallocated precious metals. They are no longer viewed as stable liquid assets. They are now labeled high-volatility, illiquid assets that require 85% stable funding. Let's translate what that means for a bank like JP Morgan or HSBC. Under the old framework, a bank could short $1 billion worth of silver with almost no capital cost. Because the contracts were labeled low risk, reserve requirements hovered near zero. It was cheap, effortless, and highly effective for suppressing prices through synthetic supply. Under NSFR enforcement, that same billion-dollar short now carries a crushing capital burden. Regulators now demand $850 million in Tier 1 capital behind it. Tier 1 capital is real money, cash or sovereign equity, the most expensive capital a bank can hold. The cost of suppressing silver has gone from negligible to catastrophic. The business model has inverted. Shorting silver is no longer profitable. It is financially suicidal. Now let's examine the size of the trap. Look at COMEX open interest. As of Friday, February 6th, total silver open interest stood at 412,000 contracts. Each contract represents 5,000 ounces. That equals roughly 2,060,000,000 ounces of paper silver. That number becomes terrifying when compared to physical reality. Registered silver, the only metal available for immediate delivery, totals just 64 million ounces. Divide paper claims by physical inventory, and the leverage ratio is 32-1. 32 claims exist for every ounce of real silver. This imbalance persists only through confidence. Traders roll contracts without demanding delivery. NSFR destroys that balance by penalizing paper exposure. Banks now face three options, and all of them obliterate the current price structure. First, they can buy back their shorts. That turns them into forced buyers in a sellerless market, igniting a self-feeding short squeeze. Second, they can attempt to convert unallocated positions into allocated ones. Allocated metal remains a Tier 1 asset with zero risk weighting, but where do you find 2 billion ounces of silver? Annual global mine supply is only about 850 million ounces. The metal does not exist. Third, they can raise massive equity to meet reserve requirements. Try telling shareholders you need dilution to back a losing silver short. That conversation ends instantly. This brings us to the failure of the suppression engine itself. For years, silver prices were smashed with algorithmic precision at predictable times. High-frequency spoofing created phantom supply to trigger selling, then vanished before execution. But NSFR applies to balance sheet exposure. Even temporary positions now trigger capital charges. Compliance departments cannot allow violations, even for minutes. The machine has been shut down. The endless paper supply that pinned silver at $20 to $30 is gone. Price discovery has begun. Only physical inventory matters, and the vaults are empty. This is not a liquidity crisis. Banks have cash. This is a collateral crisis. Fiat can be printed. Gold and silver cannot. Regulators have decided only unprintable assets count. The fractional reserve metals market has reached its mathematical endpoint. To understand why today is different from every prior panic, we must look backward. In 1933, Roosevelt's Executive Order 6102 wasn't about stability. It was about insolvency. Too many gold claims. Not enough gold. The government changed the rules. Confiscate. Revalue. Default disguised as patriotism. In 1971, France demanded gold. Nixon closed the gold window, permanently. Another default. Today's actors are different. The script is identical. NSFR is the modern gold window closure. But this time, regulators are forcing banks to stop selling what they don't have. Unlike 1980 or 2011, regulators are not protecting shorts. They are attacking them. The banks have lost cover. Meanwhile, Eastern central banks saw this coming. For years, China and Russia accumulated physical metal while the West suppressed prices. In 2024 alone, China imported over 7,000 metric tons of silver, a quarter of global supply. It went into strategic reserves, not jewelry, not electronics, strategy. The West sold real wealth for inflated paper. Now the trap snaps shut. BRICS nations understood the deadline. They hold the metal. Pricing power shifts east. London and New York lose control. Physical markets take over. Paper prices may crash briefly. Physical prices will explode. The spread will become historic. This is 1971, but the metal is already gone. Now step into industry. Silver is not optional. It is the most conductive element known. Solar panels, EVs, semiconductors, missiles. None function without it. 15 years of price suppression crushed mining investment. Supply stagnated. Demand surged. Solar alone consumes 20% of supply, projected to double. Industrial buyers do not care about COMEX prices. They need metal. They will pay whatever is required. Banks cannot survive that move. Refinery inventories are draining. Premiums on 1,000-ounce bars are decoupling. Retail dealers are sold out. Try buying silver at spot. You can't. Real prices are $40 plus. That gap is the truth. This is how currencies die. Paper prices become meaningless. Physical reality asserts itself. Silver is a tiny market. One tech company could absorb annual supply. Everyone is rushing for the same pinhole exit. Industry, central banks, smart retail. Only paper holders are left exposed. So where does this leave us? 3 futures. 1. Money printing delays reality. Silver spikes via inflation. 2. Force majeure. Cash settlement while physical prices double. 3. Full reset. Metals regain monetary dominance. My advice is simple. Ignore the screen price. Trust weight. If you hold it, keep it. If you don't, time is running out. The data is linked below. Verify it yourself. This is not another cycle. It is the end of an era. Stay safe.